Hey, what's going on? It's Jeremy back with another video. Um, I wanted to revisit this because the weekly bias video that I actually shot yesterday. Today is Sunday, the 21st, by the way. So, the video that I did yesterday in the weekly bias, I've been talking to you about I don't necessarily want to call it just like a concept or a theory, but I mean it's something that is known basically in different trading environments, different instruments and whatnot that are traded, which is called the initial balance. And one of the things that I was talking about even in the weekly bias, and then it was separate and aside, but it was inclusive as well. Like to kind of give you an idea, is that you can always I basically said that you could use the initial balance to kind of guide you and baby maybe baby maybe corroborate or give you, excuse me, different confluence. I'm drinking this Monster. Not sponsored, by the way. You should sponsor me. I drink a lot of Monster. But not a lot. But the initial balance can essentially give you more confluence in terms of whatever your overwhelming or your potential bias would be. So the initial balance would give that to you. So basically, in a nutshell, without going like way off the deep end with a bunch of technicals and whatnot. So the easiest way that I could define initial balance for you, I would say it's going to be the price. It's a price data that forms within basically the first hour of a trading session. So and it's I want to say that the trader or the financial institution's definition of that would be that first hour of price data as it relates to the trader activity. So we'll just go with the very simplistic version that the initial balance is basically the price data that forms during the first hour of a trading session. Let's just stay there because the initial, like I said, the additional information can send us down like multiple rabbit holes because then it's dependent on what type of investor are you. Are you more of a technical? Are you more of a fundamental? Are you so because that will play a part. So I'm giving you a simplistic, and simplistic in my in my mind sometimes is technical. So that's what that is. Now, technically, you can have at bare bones, it is the simplistic is the first hour. Bare bones, some can take initial balance in segments, and the segments should not be taken in less than 30-minute segments. So you can theoretically have, and I know I just said I was going to make it simple, and you're like, God damn you, Jeremy. You said simple, now you're adding shit. Take the first one as a simplistic. I'm just showing you, like, if you want to go research, and I would tell you by all means, everything I'm giving is informational and take it with a grain of salt. Go do your own research, go look it up, go see how it works. All right. But the first hour of data, that first hour can be reduced to 30-minute segments. Okay. So we already know, like, New York session uh, opens, or the actual open for the market is 9:30 a.m. So that's why when I was giving the example yesterday, we'd look at the 9:30 to 10:30 window. That's the initial balance. I was also giving you the indication that if after and just beyond that first hour, if there is price data or there is a move in any particular direction beyond the scope of what that first hour of the initial balance is, that could be an indicator of what the bias will be for either for the remainder of that day. It could be the bias that's being put in place for the next couple of days or that week. It depends, and that's why I said it could be utilized as a different not a different, but an additional confluence to maybe what your weekly bias is. So I have pound yen up here. Let's go to something. Um, let's try an indice, and let's just try let's try Nas 100. And I know we're on a Friday, so let's go back. Let's look at Monday, like of last week, which would be the 15th. So this is the 15th. 15th. That's 11. Do, 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 do. Okay. So actually, and this is a perfect example. Not perfect, but this will be a good example because this actually will reference something similar to what I said to you yesterday about uh, invalidation. So I'm gonna go a couple of that's 9:30. It's 10. It's 10:15. That is 10:30. Okay. So let's go up. I usually like to try to go over one so I can make sure that I get it right. That's not going to be exactly perfect, but it'll be close enough for what I'm trying to show you. Okay, so let me make this bigger so you can see. All right, so the blue shaded box here, this is Monday, so just so I can zoom in, I don't know if how well you can see that, but that is Monday the 15th of July. So this is a week from last Monday. So tomorrow to be a week ago. I'm not from the future. I kind of wish I was sometimes. But so this is last week's initial balance. So this is the example that I was giving you just in terms of what happens when you have the initial balance. It forms. It shows you that it potentially like that bias will go in a given direction for like the day or whatever, right? Okay. So here's an example of excuse me how the initial balance can sometimes be invalidated and why you have to wait, right? So if you had nothing else to go off of, right? Nothing else. You get to 10:30, you see this break above. There are a lot of other trading channels, YouTubers, whatever, that are going to tell you, hey, once you see a break and a retest, you can target whatever. I'm not going to tell you what your RR is going to be, your risk to reward, like 1 to 2, 1 to 3, whatever. I'm not going to do that. I'm simply showing you like these are tools that you can utilize that will give you a framework to add to your arsenal of trading tools. So in this particular case, last Monday, you had the initial balance that was set. Okay. You did have a closure above. But if you notice, within about, what is that, 45 minutes, you were right back inside. Right. Now, I have to be kind of careful for what I'm about to mention to you because it does deal a little bit with candlestick structure. And I can only explain it to you from my point of reference or how I would look at initial balance when it comes, well, how I would interpret initial balance in relationship to price action when the price is shown that it potentially will go in a certain direction, when it retraces back into the initial balance, and what can be inferred from that. So, what do I mean? I'm going to explain. So, you have the closure above. This is the closure above your initial balance. With in, like I said, 45 minutes, so 15, 30, 45. By the time we get to the next hour, you've got a closure back inside the initial balance. I treat, and this is why I say go look it up, research, do whatever your independent is, and whatever you're able to derive from it. But I treat the initial balance somewhat similar to, I would say, like a fair value gap. I look at everything as, not everything, but I look at situations like this as something that has a mean threshold or consummate encroachment, right? Which means I'm looking for really no greater of a retracement than 50%. If it is greater than, if there's a closure greater than 50%, there has to be a reasoning or a logic behind it. Is there a breaker that's contained within the confines of like that hour? Is it a mitigation block? Is it what would be considered like an order block? Is there a true fair value gap that is beyond the consummate encroachment that could usher in like a rejection that will go back in that direction? So it has to be very, very specific to that, right? So in this example, there is a fair value gap here, right? So there is a fair value gap. However, and like I said, I don't want to make this too convoluted, but the same reasonings. Wait. Let me just make sure that's fair. No, actually, there is not. There's one here. There's one here, but not there. Okay. I just wanted to make sure that I wasn't messing up because I haven't. Unlike some people that you know preview like charts and instruments that they're going to give you examples of, I don't like. So this is one of those examples where I've also said I don't edit my videos. So if I'm gonna fuck up, I'm gonna fuck up in real time. You're gonna see it. I'm not editing it. I'm gonna record it. I'm gonna post it, and then you're gonna be like, yeah, he missed that. So um, I want to just show this to you, and we'll just mark that out as a 15. Wow, that's horrible. Same color. Sure know how to pick them. Okay, so let's just do it this way. Um, Turn that middle line on. Let's make it that color, and we'll just clear this for right now because this I just need to show you. So this is a fair value gap that is within that initial balance, right? So if you go back to what understand what I just said. Okay, so this would be the consummate encroachment. So that would be basically like the 50%, where I say basically I don't really want to see any retracement that comes back beyond that unless there is a reason, right? There has to be a technical reason for you to want to come back beyond that. So like I said, in this case, you got a fair value gap that's there. Okay, here's where you have to be acutely aware. So from a candlestick, from a liquidity standpoint, from a mitigation standpoint, when price comes back into that, if you just extend the fair value gap all the way across, this is now an inversion fair value gap. Okay, and this is a 15-minute chart, so it's not like I'm on a 5 second or 1 second chart where you're like, well, by the time I see that, it's gonna be too late, and it's a 15-minute chart. So when I say that, a lot of times you kind of don't want to see the initial balance and price just run away from it. Sometimes it will do that. But when it retraces and you're looking for, okay, it looks like it's going to be a long, it looks like the day is going to be bullish. It looks like maybe the week's going to be bullish based on my bias. Here's the initial balance. This is how it prints on a Monday. Okay, it's retracing. What, like, even before it gets to that point, it's always good to kind of go back in and look. So even here, you could say, okay, well, I know you're probably going to ask, well, hey, Jeremy, did you miss this one? I didn't. So I use that same premise a lot of times where I'm looking for the fair value gap that's the furthest away. So even if there's a break in market structure, whatever it is, I'm looking at price action. I'm looking at what's occurred before, and then I'm looking if there are multiple fair value gaps. I'm always looking at that last one. It doesn't always mean that it's going to be tapped into. It could be left for a future price run. It could be utilized to engineer liquidity. There could be a low that's just above or above or below whatever that condition is. So I didn't not see this one. I just looked, and initially I said, okay, there's my consummate encroachment or my mean threshold for my initial balance. There's a fair value gap below that. So we don't really consider this. The fact that this wicked all the way through, there's a body closure above. The reason And I know hindsight being what it is, hindsight is sometimes it could be a tool, but this can also help you just in terms of looking at what is the delivery, right? So hindsight makes it real easy to say, okay, well, price just kind of went all the way through this, but this fair value gap here, you could say, well, it was respected. The body, the body told the story. The wick did the damage. The body told the story. Well, it did. Absolutely, 100%. It told the story. It told me that this body closed inside this bearish candle. It also told me that this body closed well under 50% of this body's candle. So there's a likelihood, a higher probability, not an absolute, but a higher probability the next candle open is either going to continue or we're going to get a little bit of indecision, maybe, engineer some liquidity one way or another, or it's just going to fail down. So I know hindsight, we could look at that, and I'm not a genius for seeing that. Now looking back at it, you could say, okay, two bearish candles, this bullish rejects within the confines of this fair value gap. But interestingly enough, this bearish candle tapped into this fair value gap. So it kind of, I don't want to say it's no longer valid. I'm saying that that fair value gap has been tapped. You get an extreme that pushes further down. So yeah, can you say there's been some liquidity acquired? Yeah, I guess you could say that. But the candle closure is still within this body. Again, as it relates to initial balance, this is the furthest fair value gap away. We got a closure below this. So now this doesn't necessarily mean that because the closure is below this fair value gap, that the initial balance is now invalidated for bullish price action. What it could mean for you, what it in realistically, again, hindsight tells you it might not be valid, meaning that might not be indicative of the initial balance for bullish price action. There's something that, there basically price is going to have to be paired, or there's additional mitigation, there's additional liquidity that's being sought, and that's not the true move, right? All just things to think about. So in this instance, I'm trying to keep my head out of the way. I know I'm moving this over. But in this instance, we do see it runs through, it closes below. Again, this bullish candle closes about halfway up. And then essentially by the afternoon, so the 1:30 candle basically closes below this initial balance. Whenever you have your initial balance, and I feel confident enough telling you this because I'm pretty sure that that's how I haven't followed NAS this week. So I'm going to pinch this down just to look if it continued. It probably continued short. Yeah. Yeah. So it fell off. Whenever this happens, it's not 100%. I would challenge you again, and I know I've said this a few times, so I don't mean to sound like I'm beating a dead horse, but whenever those things happen, I think I got stopped on that. But whenever you see initial balance run to one side and then it clears the other side, you can look at that and you can consider that a form of like a Judas swing. You can. I'm not telling you to look at it that way, but you can look at it basically as the invalidation of that initial balance in whatever the I don't I'm trying to choose my words and my vocabulary properly here. You could look at that first move outside of the initial balance once it clears the other side as a false bias. So in this instance, the initial balance basically was set. It was triggered where you would think, okay, price was going to be bullish. It came back in. You found a fair value gap. It basically made the fair value gap an inversion fair value gap, basically meaning it is not supportive of longs or bullish price action any longer. It is now inverted. So the potential is now there may be another fair value gap formed that for support of bearish, or it's just going to run the initial balance short. It's going to run it out to the short side. Once you see that, if it runs the opposing side of the initial balance, the initial balance is invalid. Okay, that's again, that has always been my interpretation of how I look at initial balance. It's telling you what the parameter is outlined just within the data for that first hour. It's a framework. It's not an absolute. So the framework for the first hour would say, okay, well, price is bullish. Now you're looking for something substantial that's going to support that. So the substantial support is if you've got fair value gaps that exist within the initial balance. If those fair value gaps, if that price mitigation, if that price liquidity supports continued bullish price action, not less than the mean threshold or the consummate encroachment of that initial balance, if it's supported, then you can look for opportunities to position yourself for an entry. And if it's just as simple, if I'm just talking again, in simplistic terms of a target, just target the high, right? So in an instance like this, I realized that it violated, and I'm going to give you an idea, just an idea of what you can do in this scenario. But let's just say, just for kicks and giggles, that instead of this being an inversion, let's say that this was going to support bullish price action, okay? And let's say that it came in and you get a wick clear. So basically you get the wick that does the damage, the body tells the story, and maybe the body just resides at the very top of this fair value gap. Well, obviously you can drop down to a lower time frame, look for the snowflake, or look for basically that fractal that could exist. So this is a 15, so you can go all the way down to a 1 minute if you wanted to. And it could be just as simple as not going crazy. And again, just concept, right? It could be as simple as your entry being somewhere around here, the stop being wherever. I'm just randomly putting this. So if the wick comes all the way through, but the body closure is above that fair value gap, you literally can target the high. And me, that's as far as I would go, because you never know whether or not there is another level or layer of price action, or what array or what range you might be in, unless you're looking at a higher time frame. If you're basing it on a higher time frame, then yeah, you're going to have another target. You might have a higher or a more long-term target. But even if you have that long-term target, I would say you could target this for a partial, let's say, and then maybe move your stop to break even, just based again on how price is delivering. Okay, so that's the idea. That would be the idea if you were still maintaining an initial balance for the bullish price action. So I said I was going to give you an idea. This, again, it's just a thought, and it's something that you could look at. So when you do have these types of swings that invalidate an initial balance, what I like to do sometimes, and it's a little unorthodox, but it's just a framework, right? It is only framework. When I say, you could look at this as maybe like a Judas, sometimes I process it as like a breaker. And the reason that I take that concept is it's kind of like I'm using it almost like it's its own initial balance, but beyond that hour time frame. What do I mean there? Okay, so let's go back here, and I'll just move this right there. So what I mean by that is initial balance has been established, right? Bullish, fair value gap, closes below the fair value gap. The likelihood it's, we're not going to remain bullish. I don't know that yet. We have to wait for price to play out. So price plays out. We get to 2 p.m. Monday. And I'm going to say this again. I just scrolled over just a few minutes ago, and it did run short. So this is, again, you could say hindsight, you can call it whatever you want. I, again, will challenge you. Go into your charts, draw, draw a box around with a mid-level line and whatever for your initial balance. Look at any asset you want, and don't just find the ones that deliver once they present themselves to be bullish or bearish, that come back into the initial balance and then run in that direction. Find the ones that do this, and then just try this and see what the result of it is, because sometimes it helps. And like I said, it's like anything, there's nothing 100%, but I always feel like the information that can be shared amongst the community, amongst people that not necessarily are looking for strategies and plans, but maybe, something like this, I would always say, is just extra information on the table. It just gives you a little bit of different insight into when there is a price delivery, or there's a seeking of liquidity, or there's an inefficiency that's having to be rebalanced in the overall scheme of price delivery. Sometimes these types of informational pieces can include, I'm not going to say they paint a new picture, but sometimes they include like maybe the missing piece that allows you to say, oh, that's why that ran here. And then you go back or you revisit a higher time frame, and now you're looking at, okay, if that initial balance didn't run out, or if that initial balance wasn't invalidated, then this move, which looks like it's a more long-term move, would not, marry, or wouldn't line up with whatever, the higher low of that range, or the higher low that looks to be taken out or rebalanced. Like, that wouldn't happen, right? So in this instance, this would have been a high. I said 2 p.m., right? So that's the 2 p.m. candle. So once it's cleared, and technically it's cleared here at 1:30, but the reason that I'm picking 2 is for a very specific reason. The 2 p.m. candle is a definitive low. It's a significant low. It's the low here, right? This 11:15 is the high. Now, I talked yesterday briefly about lunch hour. Don't trade it. I don't. I'm not telling you not to trade it. When I say don't trade it, I'm saying I don't. I've done it a couple of times. I was successful a couple of times. I was smart enough to know I wasn't smart enough to trade it consistently. I stopped, right? But a lot of this is lunch hour into one. So what you can do when it invalidates your initial balance is, now I just put the whole damn thing. It doesn't matter what it is. I look at that and I say, okay, this is now a different kind of range for me. So this is basically like, hey, my initial balance was violated, right? So this is the range under which my initial balance was invalid. So I treat it as, okay, well, maybe this was done and then invalidated to gain liquidity. Maybe there was some buy side liquidity, and if I'm just looking at the 15-minute, and we can zoom out, we can go back and then zoom out to see, but maybe there was a reason for liquidity to be sought last Monday morning and then run short. So the reason I draw this out is to say, okay, well, if that is truly liquidity that's been swept, buy side liquidity swept, maybe this is an intermediary protected high, meaning this is a high that's been determined for whatever the time duration is. Maybe it's just for, 15 minutes, a day, 4 hours, whatever. This is a protected high at an intermediate level that will allow for the delivery to run sell side liquidity, acquire rebalance, right? That's why I do this. And then if that is the case, what happens is you can draw this all the way across and see, same premise. If you notice, like I try to make things relatively simple for myself. I try. And I know that, a one size concept doesn't fit all, but when it comes to ranges, the reason why I like to do ranges is because anybody that's been, I think anybody that's a support and resistance trader understands like premium discount. Like I would like to think that at this point in trading space, like a lot of people are familiar with premium discount or support resistance. So for me, I always use boxes. I always mark out a 50% or a consummate encroachment of that. When there's a invalidation of an initial balance, I'm looking at a high, I'm looking at a low, I'm looking at a clear high, I'm looking for a clear low, and then at that point, in a manner of speaking, I would then say, well, this initial balance was invalidated. This might actually be my initial balance. And the check could be something like this, but it's a wick. It's not a body, it's a wick. So sometimes you have to be careful. But again, this is why I'm wanting to do this video primarily about initial balance, and then this is still tying into that concept. So I'll say it again, not that you missed it, but just sometimes people need to hear something more than once. This was Monday morning's initial balance that looked like it was going to be bullish. Came back in beyond a mean threshold or a consummate encroachment into a fair value gap, closed below that fair value gap, right? Ran out the initial balance. That initial balance is no longer valid. It took a good 3/4 of the day to put in this invalidation range, which you could look at and say, this is a new initial balance. Or you don't have to call it that. You could keep that concept and just say, this is my new Monday daily range. This is the daily range. This is the high for now, could be protected. And the reason why I say this is a high now could be protected is because price already showed you it didn't want to go long. It actually invalidated the initial balance short. It might want to go short. This was for liquidity purposes, right? The reason that I draw this box out is to say, okay, let me confirm that that's what's going to happen. So within just this range, and I'll pull this back in. Good, my head's not in the way, almost. We'll just go right here, and then I'll slide this over so you can see it. So within this range, I'm going to just move this over real quick because we know it's this high. So in this range, what do we have? Do you notice something similar to this as to the initial balance? You got a fair value gap up here. And I will just revisit something that I said earlier. I'm going to use a 1 minute because I think it's a different color. It's the same color. Good gravy. Good gosh. All right, let's just make it blue. And then I'll take my 1 minute out and we'll just leave fair value gap in there. All right. So I want you to remember something or just recall something I said earlier. Remember when I said if it's something that is beyond the mean threshold or beyond the consummate encroachment, like it should, you could lean to that, but I don't want price to surpass that unless there's a fair value gap. There's maybe a low or a high or whatever it is that's sitting there for liquidity to be tapped. And by tapped or met beyond that point, it shouldn't be anything more than a wick. It could tap in as a wick as long as it closes above or below the consummate encroachment. You should be okay. But other than that, you still need to be looking at how price was being delivered up to that point. Okay. Or this could be just residing and waiting to be mitigated in the future for a different type of setup for liquidity to be taken, price to be paired, or liquidity to be run. That's the other scenario with this. So that out of the way, this is a fair value gap. And we'll just draw this out. And just by the eye test, I don't think that got tapped back into. But I will move this back over. I wanted to show you that. That's the only fair value gap that exists in this whole move down. Just that. Okay? So looking at that, that's why I said this is now invalid. So the initial balance not invalidated. Technically, it's invalidated at 130. Um, you get a low put in at 2. High to low to this range, you could call it a range, you can call it whatever you want. I look at it and I say, okay, that's an invalidated initial balance from the morning. So I'm gonna treat this range in a manner that says early this morning it looked like price wanted to push high, but that looks like that was more based on buy side liquidity being acquired, a short term or intermediary protected high that's going to exist until there's liquidity that's generated and then run out. Don't know, right? I would go as far as to say, yeah, I don't know. Why could I say that? Because if I'm looking just from Monday, I'm not looking at anything from the previous week. It could very well be a scenario in a situation where this is a low, but those are like relatively equal lows. But because I didn't get this box all the way down, that's a low, that's a high, right? This is a lower low. That's a high. This is a lower low, which in some instances would say, okay, well, if I get a structure break, price could go back up here, right? So depending on your understanding of structural delivery within price, you could interpret and say, okay, well, low, high, that's a low. This is a short-term high, that's another lower low. Well, I clearly have a break above here, so is there a fair value gap in here? Yeah, there's a fair value gap in here. So if it taps back in, it may run long. It's possible, but I'm bringing those up to bring you again back to this range. I hate being repetitive, but there's a reason for it. I promise. Just stick with me. I promise. The reason that I keep coming back to this range, the reason why you're going to look at how price delivers, you can also look and say, okay, well, Jeremy, aren't you saying the same thing? Like for this price range, it kind of looks like the initial balance, even though it's not the first hour of trading. This is still a range that's been set up. This is a wick clear of this new range, so it means it would go short. You're looking now for the confirmation of that, okay? And the confirmation is contained within the range, which is why I always put some kind of midline or basically an encroachment point or a 50% point in all of the the boxes and the drawings that I put on my charts. Why? Because I want to see if it gets respected, and I also want to see if it validates an idea. Does it validate the idea that price is still going to want to remain short? Because it clearly said it didn't want to go long here, right? Or excuse me, it stated like we had to get all the way back here. We had to get to the afternoon for it to say, hey, look, no, we're not interested. You really didn't have to wait until 1:30 to know. I again, it could be debated. By I would say by 1 o'clock, you should have had an idea like, okay, this probably isn't going to go very well because again, this candle at noon kind of gave a little bit of an indication. The 12:15 candle did close at on or about 50%, but that 12:30 candle pretty much told you we're not really we're not interested, right? And I'm not talking about as a candle is being printed. I'm talking about once the candle is printed, that candle's closed. It's essentially told you, yeah, not interested. We're not interested in longs. So you can wait at that point. You kind of sit on your hands for the day. Or, I know some people that would be overzealous or get in and say, hey, listen, once they saw this candle close, they would have said, hey, look, I don't have a fair value gap, but price is clearly telling me that you don't want to go back even to the high of the initial balance. So you certainly don't want to go back up here. So maybe you want to invalidate, and maybe after this candle closes, they target this low. And, at that point for me, it would be like an arbitrary high. Maybe they look at this fair value gap in concert with this break of this fair value gap, and they wait for price to get back up in here. But I'm going to leave that for somebody else to explain. I don't want to get into that. That's a deeper methodology, and it takes a few more things. And I am okay with saying I am not adequately educated to teach you, or I'm not adequately educated to even talk about that. I'm comfortable enough saying that. So, moving along, and we're at 40 minutes, so I gotta hustle through, hustle, and keep my head out of the way. All right, so the confirmation for the short, treat it as a range. Treat it as exactly what it represents on a chart. Treat it like a range, and the way that I treat them is very very simple. I try to be simple. My simple approach is consummate encroachment. If there is fair value that exists above, if there's a high that exists just beyond the consummate encroachment, then yes, I would consider both of those as potential extended areas of mitigation prior to a move that says it's going to run long or short. In this case, there's a fair value gap that resides above, obviously, the consummate encroachment of this range, the 50%, the mean threshold of this range. But when price finally does its little dance here, okay, price closes here. I'm sorry. Price closes here. It closes back inside at 4. But it's essentially told you, hey, look, we might want to go short. Invalidated the long, invalidated the initial balance. Maybe it wants to run short. This is all overnight. So what do we have overnight? Give me one sec. I want to see something here. It's 8. So you end up with, and it's very small, but I want to try to show this to you. It's very small. Let's see. So this bearish candle that I have my cursor on, can you see that? This candle right here. This candle is a 7:45 candle, 7:45 p.m. That is the low. So this is where my cursor is now. That's a 6:30 p.m. candle. You know, I've been talking to you, spent last Wednesday doing Power of Three out of Asia. So this is a situation where this was basically, these were relative equal lows. And yes, I'm going somewhere. I'm going somewhere with this. The 8 p.m. candle cleared out those relative equal lows, right? Came back up, it mitigated further, but my Power of Threes in Asia sessions say what? We're looking for a sweep of liquidity. You take that range, whatever that range is, you could do it from 6 p.m. to 7:45. Honestly, you could even do it from 5 p.m. to 7:45. It just depends on what the most recent high and low is. So in this particular instance, the low, quote unquote, is going to be the 7:45 because there've been relative equal lows that have been put in. Honestly, yeah, that's 6. And you've got a volume imbalance here. So this one's a little tricky. So we're going to just stop at 6. But just so you know, just for informational purposes, you can test it, and you can look from 5 p.m. to 7:45 p.m. and then you look for that sweep at 8, and the sweep should come between 8. Ideally, it should come between 8 p.m. and 10 p.m. If it doesn't, you just have to wait for more confirmation, or you skip the setup. because there could, like I said, there could be something else at play. But just going back, so that's 745. So you get the sweep at 8. You get a further mitigation deeper. But again, you're looking for a sweep from sell side or buy side, whichever one it sweeps. So in this case, it swept sell side. So you're looking for the buy side on the on the opposing end. So you're literally just targeting the opposing end, which is going to be up here, which is also set, ironically enough, relative equal highs between 615 and 630. We get that here. Now, you could say, how does this tie into this whole invalidation of the initial balance? Blah, blah, blah. Right. Here's where we're going. So, same instance, same general concepts. Like the power of three is not, I don't want to say that they're the same thing. I'm saying that sometimes conceptually they can be viewed the same. So when the initial balance is formed, it usually pops its head out to let you know what direction it may want to go in. It can invalidate that, but if it invalidates it, it will sometimes give you the impression that, hey, that first move was a false move. If it invalidates it and it reverses out, that could actually be the true move. Hence the Judas swing. That's why I used that reference earlier. In this particular instance, sell side is taken in the Asia session, which within that power of three concept. What does it sweep out? Sell side. What's it then run? It runs the buy side. But as you notice, it does come back early Tuesday morning, pre-London, and what does it do? It literally goes back and it sweeps all the way back out. So it clears all of the sell side that it took earlier, which interestingly enough, it then set up another relative equal low scenario to be run. It ran all of that out. Okay. And what does it do in London? It wicks the same range again. Now, is this going to happen every time? No. It's not going to happen every time. But what it shows within the confines of this entire range, it's still confined below what would be the consummate encroachment or the mean threshold for the invalidation range. It's still below that. So I'm not going to get into the whole, can you trade that? Should you trade that? What should you look for? I would only go as far as what you've seen me doing. Like I said, you can experiment. I'm not saying that it can't be traded. I'm not saying that. What I am saying is whatever your level of comfort and whatever your level of education as you build or as you add different things to your repertoire, by all means, can you seek to do this? Absolutely, you can. There's a way. And because it's pre-London, and if you've looked at all of the price action, you've looked at the mitigation, you've looked at the manipulation, and by the time you get to 11, like even in here, like once you get to 11 o'clock, 10:45 even, you could say, okay, well, we're in a manipulation phase for the after the close of New York, and now you're in Asia. Asia's already gone through accumulation. It's manipulated now. So what would you be looking for? You'd be looking for a distribution. And what would it's kind of like one of those scenarios, like what would you target at this point? At 10:45, I'm targeting whatever happened here. I'm targeting like 8:30 because you don't know how far it's going to go. You don't it can run. It can literally just take off and go, or at best, just to be safe, if you're up and about, yeah. Can you target the low? Absolutely, you can. But you're going to notice something, and this is why it's always just a good form of practice, which I could appreciate because I didn't understand this early on either. Hindsight is one thing, but I can be honest in hindsight. My honesty in hindsight would tell me if somebody was doing this video and I was watching it and I was taking notes and I went back into my chart based on the chart that they were showing, and I looked at this and I said, if I didn't have the benefit of this over here, I would say, oh, so what you're telling me is a short. Oh, damn. So that means this manipulation, this distribution, if this is real time and it's up here, you know what I'm targeting? And again, this is me being honest with you. I would be targeting this low because I would be saying to myself, oh, okay, well, you're telling me it's not going to get back to the consummate encroachment. It's not at the mean threshold. It stayed below that. This is the manipulate. I would hear the manipulation has already occurred and now we should be set to distribute. Well, where are we distributing to? It has to be to that low. And you know what would happen to me? What happens over here? It's and I'm speaking from experience. I'm telling you this not as somebody that's giving you the hindsight perspective that, oh yeah, I would have waited. No, I'm telling you a bona fide fact. I would have been targeting this low. I probably would have said, you know what? I have to work tomorrow. I'm gonna put this trade on and I'm just gonna sell short and I'm gonna put my stop above this random high all the way back here. And that's not even a high. I'm just gonna put my stop above this clear buy side liquidity that at some point it's gonna get swept out, but probably shouldn't before this distribution takes me to the promised land. And I would have gone to sleep, wouldn't have known that I was in profit down here, wouldn't have been smart enough to wait and just target, excuse me, that was a little saliva, getting enthusiastic, I guess. I wouldn't have been smart enough to target this 830 low or these relative equal lows to just take a little change off the table and go about my business. Wouldn't have done that. Probably wouldn't have been awake at 3 a.m. I might have. Get up, go to the bathroom, not look at a chart, and go back to bed. Would have been sleeping again at 4 a.m. and would not have realized until, maybe I was getting up and get ready to go back to work that I'm back at break even at best. I might actually be in some level of drawdown. Hell, if it was a really late day, I'd be waking up as New York opened, and I'd be at a loss. So I say all of that to say, low hanging fruit, best your best case scenario. Take the low hanging fruit. If you're up, available, you're sitting in front of the chart, and basically price shows you, hey, look, this is where we're gonna go. Just be smart about what positions you're getting in and what you're taking. All right. So off the soapbox, and that was my public service announcement. So we did have a distribution, but it didn't clear this low. But what it did do is reverse all the way back up. It swept everything else out. So why would it do that? Just out of curiosity, why would it do that? This time frame, I also mentioned this yesterday, whole lot of foreshadowing yesterday that I didn't really foresee coming into today to do this video. But you can actually take the London session, and this is something that I'm still working on, so I would say again, just take what I'm saying with a grain of salt and don't believe me. Go test it. Just test it. And it's like everything else doesn't work 100% of the time. It does not. There is a high probability when you pair it with other price action that will show you. And this is just a good example of it. I said yesterday that London was always referred to, and I didn't hear it that way. Like, I didn't process it when I would hear people say, oh, well, London session is the manipulation session. They would describe it as the manipulation session. So London Open is 3 to 5. Some people will say, well, I do 2 to 5 because it's the pre, some people are all the way down to, well, pre-London starts at 1:30 a.m. Eastern. London Open, London session, London Open is 3 to 5. The manipulation will typically show up between 3 and 5. However, it can take all the way up to the New York Open to validate that. That is what's happened here. So I've deliberately kept my mouse and cursor over this 3 a.m. That's my 3 a.m. high. This is 4 a.m. That's a low, which means 5 is here. So 5 a.m., not really in any level of existence because 3 a.m. is the high, 4 a.m. sets the low. I'm going to put a couple of horizontal lines on here just to kind of show you again that once you go into the next session, I'm not saying that the previous session is not relevant, but you don't have to focus on the previous session. So you just wait for another invalidation. We got the invalidation long. That was the clear. And then it's the same thing that happened with Asia. Same exact thing. You get the sweep out of buy side here. What would you then be looking for? You're looking for another opportunity to sweep out the sell side. But what would you possibly be looking for in terms of an entry trigger to really utilize or focus on that sell side? You'd be looking for something like a fair value gap. You're going to obviously be looking for displacement of some sort. You're going to look for maybe a closure below the most recent low. Like you're going to be looking for structural points for that. But what you're also going to be keeping in mind is, and I keep reverting back to it because I don't want you to get drawn into one thing. Just to let you know, it's all still connected. You're still in this range from the previous day initial balance invalidation. You're in this range. You're still below the mean threshold for that range, which would still support the idea for no longer are we looking for longs. We're potentially shifting. There is some bias change for shorts. So now that is still, this would still be basically here, just a intermediary short target. That would be a target. Let's change that to green, right? That would be your short target. I can move my head out the way. All right. This would be the short target, and that's from 345. But you're into Tuesday. What do you get here? That's 615. So this is your first clear of buy side liquidity from London. So this technically happens after London, but what did London do? London set up a range for to be manipulated. Okay. What do you also have within, and I'm not going to get into the nuance between the pre-New York session and the pre-London, but essentially it works the same. And like I said, it's taken me, and I can be honest about it, it's taken me about 4.5 years to start looking at price delivery and structure differently. I've live streamed on this channel individual trade ideas and concepts and not utilizing a full arsenal of everything that I know. I've honestly recently started doing that. I would put, and you could go through my channel and you'll find components of things. You'll find me doing macros. You'll find me doing silver bullets. You'll find me doing order blocks. I think I have like some old videos of doing order blocks. There's a live stream that I recorded. I want to say, oh gosh, this might be like last year. It might be a couple years old, but where I basically took a market order and I let it run for whatever the period was. Like I literally just set it up. I did the technical set and forget. It delivered, but like I've always introduced like just concepts and not an overall understanding of what's the comprehensive view for this instrument, right? I'll say it again, 4.5 years. Only within maybe the last 6 months or so, I started to just kind of look at what's my bias, what confluences exist. And it's not the confluence. I know some people talk about ST and divergence and that works for them. I I probably could process that way. I don't process that way. The whole SMT divergence, I honestly not spent a whole lot of time trying to understand if one does this, then the other one's going to do. I'm not. If it works, it works. It's great. It works for other people. I'm starting to understand, and that's why this space is so interesting, and I think that's why it's compelling. I also feel like that's how some people that try to share are misunderstood, because we can all be looking towards like the same objective, the same goal. We all may have subtle differences in terms of how we actually accomplish, persevere, and get there. So if it's just information, like this is just an informational piece to maybe fill that one piece of missing data for somebody to be able to know how to get in, get out, or what to look for. That's the sole purpose for this. The sole purpose. So I'm not going to get into what occurs here, but I will just say that what happens here is what happened in London and also what happened back here in Asia. There's another period of accumulation, manipulation, and distribution, which ultimately, like it's almost like it's stacked. It's layered at this point in pre New York. The pre New York is layered on top of the manipulation from London in this case, and at 9:30 on the dot, the opening of Tuesday, we get a wick mitigation of the mean threshold of this range. One more time, I promise. Hopefully, this is the last time I say it. This will not happen all the time. It is a means by which you can kind of pair up confluences and pair up ideas that will show you, again, what is the potential of this move? What is the potential of the market moving in this direction? Okay. One more confluence we're going to add to this, though, because I think this would be very helpful. And then shortly after that, we're going to wrap this up because we're over an hour. But I think it was an hour well spent. So you get to tap back into the mean threshold here, and then you get a very beautiful displacement short. Obviously, for a couple of reasons that we've kind of outlined looking back here. Yes, again, hindsight. Yes, it is. But a very clear low, clear low. The manipulation of London. This is a sweep out of all of the resting buy side liquidity up here, but it goes right into the mean threshold and doesn't seek this fair value gap. It happens sometimes. It just does. The displacement here will confirm this low has been taken out. So that's the most recent low. So this is your breaking structure. But it also does something else. And I'm going to move this over, and we're gonna do another handy dandy box here. Okay, we're gonna do one more handy dandy box. You might like this one, or not. I don't know. So that's a 10:30 candle, right? We already said this is a 9:30 candle. So I think it's very understandable that everybody already knows we've invalidated Monday's initial balance, which was bullish. So when Tuesday rolls around, Tuesday morning open, if you studied price action, or not, maybe not studied, but there is a certain amount of research that we're going to, so you could say you studied it. That just will not cooperate. There you go. All right. Thank you for being cooperative. Thank you. Thank you very much. Okay, so here's Tuesday's initial balance. So Tuesday's initial balance has done really one thing very well. Technically, it's done two things very well. Just looking at it. It's done two things. One, it's given you the displacement below this London low, okay, it's also given you further confirmation by two defining characteristics that price is, well, three rather, that price is highly likely to run short at this point. Three, I'm going to give them to you. Here's the first one. This was the low that was set the previous day, PM session. It was 345. Not only do you get a sweep of that sell side liquidity, you get a body closure below it. Clear indication. It's further confirmed by the fact that you had this massive displacement. And oh, by the way, that displacement was started with a wick clear or a tap into the mean threshold of the invalidation range from the previous day's initial balance. Also confirming the potential of no longer are we looking for longs, you're looking for shorts. We've only looked at the 15-minute chart. We've not looked at anything else. I believe ICT refers to it as like the bellwether. So I didn't understand, and I'm not really going to go too far into that. So I'll just stay focused because I can get distracted and be talking about that for another 20 minutes. But those are your confirmations. Consummate encroachment mean threshold tapped into for this range that invalidated Monday's initial balance. Tuesday's initial balance clears a recent low, clears a previous afternoon PM New York session low with a body closure. And you also have not one, you technically have two fair value gaps that have formed. So in either scenario, if you were overzealous and you just wanted to, jump in, could you jump in here? Yeah, you could. You put your stop above, or you can literally go all the way up to the consummate encroachment or the mean threshold. You could put your stop up there. And you said, well, if I do that, where am I targeting? Once price shows you here, and this is 12:30, you have a couple of opportunities, really. If you don't want to trade the lunch hour, but you keep the trade on through the lunch hour, which I, again, already talked about that, I wouldn't recommend. If you take a position once you see this closure and it's 10 a.m., and you are going to get some level of retracement back into, do you notice what happens here? And this is why I wanted to say I felt like it was going to be important to show this to you. And I got one more box to draw on here, and like I said, I'll be wrapping up. I promise. Like all these damn boxes. But they're important. So you block that. Okay. So I'd said to you earlier, you can look at the initial balance. When you look at the initial balance, you should always consider fair value gaps that are above and below. You look for that same criteria that, the wicks are going to do the damage, the body's going to tell the story, right? So even with the displacement, even with the closure below, you have two fair value gaps. Always prefer the furthest from. There's a reason. So this is the first fair value gap. There's not really a candle closure below this low. If you wanted to consider that a low, you could. Technically, it would be. This is a low. This candle clearly took that out. So you could say this one, it doesn't matter. It's a matter of preference. But for argument's sake, we're considering this one because within this initial balance, let me make that that midline black, and I'm going to make it a little bit thicker so you could differentiate between the two. Okay. So the heavier is going to be the mean threshold for Tuesday's initial balance. And remember when I was telling you, if there's a body closure beyond that, you have to show me why. Okay? If there's a fair value gap above it, my conviction is greater if it's a wick through and it closes below in a short. but there has to be something that's going to show. This is an extreme example of where you can get a body closure above that mean threshold, but based upon the price delivery prior to, you might have the conviction to just kind of hold it, and you'd be willing to accept the risk of a potential loser just based upon price action. So this higher fair value gap in this break, not one body closure above consummate encroachment. The wicks went through the consummate encroachment, not one body closure above that. Let me make this bigger so you can see. So there's nothing ambiguous about what I'm saying to you. You can see it. Okay? Somebody would argue, well, that's right on it. Yeah, it is. It's not above it. Wick, wick, wick. And then there were none. Right? So you do, however, this would be the mean threshold of the initial balance. You've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. That would be 17. So you have basically 17 body closures above the mean threshold for the initial balance. However, again, the strength under which price is broken down, right, came back up initially. And if you notice, it respected it initially to do what? To point you in a direction that, hey, we're probably going to go short. Now, if you remember back to Monday, let's go back to Monday real quick. When it came back to the consummate encroachment, it ran right through it. It closed below. And there was a fair value gap back here that it closed below. It never even attempted to get back up here. Not once. Not one time. Not one candle showed you basically that it was going to be relevant to say, hey, we're thinking about not one iota. And this is once it actually established. Let me go back and I'll show you again. Once it established that it cleared, it ran straight up and through and came back in. So that's the other thing. Notice the difference here. The initial balance was set, but it immediately came back in to the mean threshold and it went away. It moved directly away from the mean threshold of the daily balance. Now, I've got this all the way out at 4 p.m. So let me just move this back to 10:30 so you can understand exactly why I'm saying what I'm saying. That's your initial balance for Tuesday. Do you see the difference between Monday and Tuesday? Mondays went straight through. It pointed the way, and then it came back and it said, we don't want to do that. Tuesday's initial balance set the range, did not give any indication, came back in, visited the mean threshold, and then it displaced back and said, we want to go short. Then it came back in, revisited the fair value gap, the furthest from this break, did not compromise the fair value gap consummate encroachment, and then eventually price broke down and went short. So I know this is a little bit more comprehensive beyond just initial balance. This was initial balance bias and some price action thrown in there. So hopefully that helps somebody. And hey, if you like the video, if you got something out of it, let me know. Leave some comments below. And again, I would just challenge you, just try any instrument, any asset. This is something that can be invaluable. Like I said, at times it can keep you out of bad trades, bad situations. It's also, I like to look at it as a confluence or a vetting instrument or a vetting tool that literally, if you just don't feel comfortable about it, that's enough for you to say, okay, draw your boxes on the chart, draw it out, look at it, and say, okay, I'm gonna let this one pass, and that's okay. The more that you allow to pass, even if they play out based upon what you think the bias or based on what you think is going to happen, it's not. Don't look at that as an opportunity that you've missed or you've lost to make money or to pass, your eval or to 2x, 3x, whatever your funded account. Look at it as just an additional measure to confirm maybe your mechanical strategy or what your bias would be in certain situations. Look at it as just that. Look at it as you're reinforcing the plan. You're reinforcing all of the steps and the methodologies that can make you successful and profitable. So just treat it that way. Don't treat it as a missed opportunity. Treat it as fact and information gathering, and that will take you much further than trying to hit the home run. Sometimes a sacrifice bunt is always better. Sometimes. All right. So with that said, hope everybody has a successful trading week. I will see you guys. I don't know, maybe one day this week in the evening, but if not, I'll see you next weekend. So take care. Thanks.